In today's episode, we talk about the current lay of the land in the multifamily lending space. We talk about rate caps, bridge loans, the biggest issues operators are facing, and some new modification that lenders are coming out with in order to get their lending back on track. Lenders want to lend. Eric Stewart is our resident expert on lending. He is the owner of Atlantic Business Capital, a full-service commercial lending advisory and brokerage firm, and also a really successful syndicator. Let's get to the show. Tell us, Eric, if you where do you see us right now? What's the lay of the land on the lending world? We've been hearing a lot of stuff going on. There seems to be some cracks in the system. From your vantage point, what are you seeing these days?
Big picture, I want to make a few blanket statements, and then maybe
please.
we can kind of just trail off of those. One, and this is pertinent to our borrowing, is we are at the tail end of our tightening cycle, right? These rate increases, they should be tapering off. We should be at the tail end of them. That's the first thing. Second thing is when you hear the Fed raises their Fed funds rate, it's not in lockstep with what your interest rate is that you are borrowing off of, right? You guys, as multifamily owner operators and borrowers, you are borrowing off of a margin most of the time with your stabilized permanent debt off of a treasury yield. So when you are trying to determine what your interest rate is going to be, I would ask you not to look at the Fed's funds rate and say, oh, they raised it a quarter point, so now I have to underwrite a quarter point higher. Prime rate, oh my gosh, it's at 8% right now. Well, my rates are going to be 8%. This is crazy. You're working off of the treasury yield. So if you look at the 10-year treasury, the 10-year treasury bond, and look at what that yield is, right? Today it closed at 3.57, which is slightly higher than where it's been floating. That is what your permanent agency lenders, your Fannie Mae and Freddie Mac lenders, are going to use to determine your interest rate. Now, if you take a shorter term, they're going to use a treasury yield that's consistent with your term, 7-year, 5-year, and whatnot. But industry standard, basic middle of the road, watch that 10-year treasury yield, and it's going to give you a solid indication of overall where industry rates are. Now, they're setting a margin over that index. So again, the margin changes. It's sort of inverse with what you see with the yield. When there's turmoil in the markets, your people buy bonds, the yields drop, but the spread over that index usually widens. When I say the spread usually widens, what I mean by that is that your interest rate is a percentage over that 10-year treasury yield. And a good rule of thumb, middle of the fairway, is going to be 2% or 200 basis points. So 3.57. Realistically, you're in the mid-5s on your interest rate. Now, when you're underwriting your deals, remember, you're going to close that deal, best case scenario, 75 days, maybe 60 days from when you're actually underwriting the deal. So I would ask you to give yourself a little bit of a buffer there, maybe underwrite it a quarter point higher, maybe half a point in volatile times, but at least a quarter point. Now, so let's say you're 5.5, 5.75, and you're underwriting. That's on your permanent debt. So when you hear about the Fed raising rates and Fed lowering rates, it's more about what the market, and I say the market, I mean the equity stock market, has priced in for their expectations. That's really important, guys. It's more in this market, because news travels so fast. Everybody wants to get ahead of the curve. Everybody's right at the starting gates, trying to get ahead of what these market moves are. It's more about what the Fed says than what they do. Now, what they do is crucial. Like, let's take this last rate hike of quarter point, for instance. If they hadn't have done that right after SVB and Signature Bank turmoil, if they hadn't have raised those rates, that would have sent a message of weakness. That would have sent some serious concern out there. So I feel like it was the prudent thing to do to bump that up a quarter point. There's like a 78% chance that we're going to see another quarter point here in May. And then the expectation is they might bump again or lay flat, and then they're going to start thinking about leveling off, maybe even lowering, right? So again, I go back to my original statement. We are at the tail end of this tightening cycle. Second thing I would ask you, and that was really a long explanation, forgive me.
No, that's great. By the way, before we go number two, I was just going to show a quick chart because this is what I was trying to show last time. And so when we met last time, we peaked right around here in June, and then we kind of went back down, and then we went really high. But now we're kind of just a little bit higher than we were back in June. But as you guys can see, this doesn't mirror the Fed funds rate, right? To Eric's point, it's all about Fed's expectation, because as you can see, even though the Fed's been raising rates over the past 9 months, this yield has been going primarily down, a little bit up here, but throughout this whole time, the Fed's been increasing rate. But to your point, it's really what the market's expectations are, which is really driving what this 10-year does.
You're absolutely right. Absolutely right. It's what they've sometimes they've already priced in a move. I mean, it's kind of like when earnings come out, or employment numbers come out, CPI or CCPI comes out. You have your expectations, and then the deviation from the expectations is what really moves the market, more so than what the number is up and down. It's what they expected it to be. It's in a similar vein. The second thing I wanted to kind of touch on is not to make your decisions based on the big headlines, because remember, there's so much information coming at you guys, either from people on stage, either from people that want to sell you publications, people want to get your attention. Be careful about just making your decisions based on the headlines, the gloom and doom, the foreclosures, waves of foreclosures coming at you, rates flying away, all these types of things. Peel back a few layers. You owe it to yourself and your investors to peel back a few layers and really understand the metrics of why and the rationalization behind it. And a key component here is those headlines oftentimes are based on institutional level investing and pension funds and $100, $200, $300 million deals where you and I are out there buying $5 million deals, right? And we're happy, we're making our act fee, we're making our cash flow, we're paying our pref, we're going to go do it again, right? But those headlines, and you go to some of these big conventions, and you see the heads of all these institutions sitting on the panel talking, well, the next 10 years we see this happening and that happening. You just want to go buy a deal, guys. So understand the metrics of your market, understand the metrics of your property, get in front of the right investors, offer the right opportunity, full transparency, talk to Mauricio and his team about how to do it, and we're going to be fine. Don't get hyped up on the headlines. That was my second thing that I would ask everybody to pay attention to.
No, that's good stuff, Eric. And you talked about the interest rate. We talked a little bit about the LTVs last time as well, and we actually talked about how I was actually pretty misinformed, thinking that the lenders were putting the caps on the LTVs, that they didn't want to lend more than 65 or 60%. But it really has to do with the debt service coverage ratio and the limits that the property itself puts in there. Are the lenders still willing, if they miraculously saw a piece of property that had a qualifying DCSR? Are there still products out there where people would lend on 75, 80% if the DCSR makes sense?
In bold letters, yes. Like the neon sign is on, right? And here's the example. Fannie Mae and Freddie Mac are, number one, their allocations were reduced, right? They would drop down to they were cut by $3 billion each in allocations for this year off of last year because of they didn't meet their allocations last year. And this year they are, as of Q1, they are way off on their volume, right? And it's truly a function of overall deal volume just not being there. I'm prepping a couple of deals that we're going to bring to market here in Q2. And in talking to various brokers, interviewing various brokers, talking to some shops that haven't sold anything since November, right? So it's the appetite of industry professionals, and this is all good for you guys on the call. the appetite for industry professionals is there to earn your business. They want to transact. As of 23, there's been certain incentives that the agencies have come out with that they're really looking to lean into, and give you two in particular. One of those is 5 to 50 units. Properties that are 5 to 50 units are I won't say they're getting waved in, right? They're not making ridiculous decisions, but they are getting incentivized to bring those deals in between 5 and 50 units. Another adjustment, and this is specific to Freddie Mac small balance, and I'm really encouraged by this because this is what I've built the last 20 years of my business on, is catering to this clientele. Freddie Mac small balance has modified their previous experience qualifications, and they have included duplexes, triplexes, and quads to qualify as previous experience. It's huge. I mean, to me, leaning into that investor avatar, you know, that investor that's built a portfolio in a market of duplexes and quads, but hasn't cracked into that 20 unit space or that 10 unit space or what have you, they're putting their arms around those people. Smaller deals, and investors that have kind of parceled together their portfolios, but they're hands-on investors. They know how to work with these tenants. They rolled up their sleeves. Yeah. And to me, that speaks volumes. And I'm really pleased to see it.
Yeah. And so the headline, again, saying to your point number 2, don't listen to the headline so much. But so the headlines seem to be indicating that, you know, lending is down, and that's a reflection of the lenders are getting a little bit, you know, they're trying to shore up cash, you know, the whole banking thing. What I'm hearing from you, though, Eric, is saying, no, the banks are open for business. They'd love to lend out. In fact, they're adjusting their criteria to almost loosen a little bit more, add some experience that they otherwise didn't accept, and also, you know, incentivizing really 5 to 50 units. So the message here, if I'm hearing it correctly, Eric, is that lenders want to lend, and they're actually loosening somewhat their underwriting criteria in order to put that money to use. Because as you said, they're under allocated to where they wanted to be.
You know, you couldn't have brought up a better point. It's so in line and so crucial to discuss the difference in lenders. And when we always have to caution ourselves of generalizing the term lender, because you just mentioned banks, you know, and banks, I think, are the inverse, right? That over the next couple of years, banks are going to be tightening up. They're going to get scrutinized harder. They've I don't know what percentage they held. I think it was over 65% of some of these commercial real estate loans were held by the regionals and the smaller banks. They are going to really have to analyze their deals and be extra careful on what they're going to do. But Fannie and Freddie are a different ballgame. Securitized debt, you know, government-sponsored enterprises, they are looking to lend. So differentiating between your bank debt, which for my clients over the years, bank debt hasn't really been the go-to lender. 1, it's typically recourse. 2, it's typically shorter amortization, maybe 25 years. 3, they're looking at they'll do 80% leverage, but they're looking at the numbers in the way they're underwriting the cash flow is not as liberal as what Fannie Mae and Freddie Mac do, right? When Fannie and Freddie look at the numbers, they take your T3, a current snapshot, and annualize that. They listen to our budgeted expenses, which is wonderful, right? Where a lot of your CMBS lenders and some of these banks, they're looking at what the seller's doing and treating it as though you're going to do the same thing. So the banks haven't been my client avatar anyway, their go-to lender. And Fannie and Freddie, volumes down, programs are as they have been. They're leaning into smaller investors. I think that's going to be a real viable source going forward. But how you get started on this whole thing, and what I want to get around to is the cash flow. As we see cap rates increase, our NOIs are going to support higher leverage. Right. As we see rates pull back, our NOI is going to support higher leverage. So to answer your question, yes, it should be turning the corner, and we should be able to support higher loan to values.
Awesome. Guys, if you got questions, put them in the chat. I see Mitchell mentioned something about his quotes that he's been seeing have been SOFR plus 250 to 350 basis point. Do they base it off SOFR? If you want to let people know what SOFR means, and do they even use SOFR in calculating the rates?
Yeah, they do actually. And you know what? Great point, because now we're starting to shift a little bit closer to most common bridge lenders, or who's going to use your SOFR rate, right? And SOFR was the replacement for LIBOR, which kind of phased out last year. And we're seeing everybody's quoting off of LIBOR. I have some lenders that quote off of the 2-year semi-swap for their rates. But SOFR, it stands for the Secured Overnight Financing Rate, and it's considered a little bit more of a true market index, a true organic index, because it's set by where the contracts are trading overnight, whereas LIBOR was actually set by individuals.
Yeah, LIBOR is like a bunch of old people sitting around a table, right, and just deciding what they think LIBOR is going to be.
Yeah, what could go wrong, right? What could go wrong? But yeah, so SOFR is more of a market-driven index, and that's most all of your lenders have converted to that. And the 250 over LIBOR, that would be 250 over SOFR. The big question that you have to ask yourself, and you want to ask your loan officer when they quote you, the SOFR quote is which SOFR, because there's more than one and they differ, right? If you get quoted the term SOFR, you got 30-day, 90-day, 180 days. And that is a forward-looking index, right? Where they're looking at contracts, and in a rising interest rate environment, like right now, the term SOFR closed at 4.93. Then you have the average SOFR, which is a rear-looking index, right? That's 30-day, 90-day, same thing. That is running, 30-day average is running at 4.79 today. So if you've got to ask your loan officer, and unfortunately, the industry professionals, we end up talking in our own jargon, right? So we used to say L plus 475, L plus 300, and that was LIBOR plus, right? And now you talk to your loan officer, and they're half listening, half not, and they're like, yeah, we're running 350 over.
Right.
Over what?
Right.
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 So then it's going to be over SOFR, and then you have to add which SOFR, term SOFR, is it the overnight, the Wall Street Journal? So make sure you understand which one is really all I'm saying.
Good stuff. I heard you say, oh, sorry, go ahead. I didn't mean to interrupt.
No,
I heard you say bridge loan. I wasn't quite sure if I wanted to talk about bridge loans next or talk about the biggest issues you're seeing right now. And I don't know if those are maybe the same questions. I've been hearing a lot about the bridge loans, and I've been hearing a lot about issues that some syndicators or multifamily operators are running into. Are you seeing, because we talked about it back in June, you and I talked about these 3 plus 1 plus 1 bridge loans, right? And we were talking about how there really are 3-year loans. Everybody thinks they're 5 years, but they're not. They're really literally, 3-year loans, and they've got a couple of extensions, but you've got to meet certain criteria. Are you seeing operators or owners running into issues now as those 3-year bridge loans are coming to an end, and they're having to negotiate with the banks, and are banks starting to require some additional collateral requirements, or what are you seeing out there on that front?
It's starting. It's on the cusp, and it's starting. Matter of fact, I was just sitting with an ex-rep from Fannie Mae today, and one of my lenders, the internal Fannie rep, we were having lunch talking about just that. And the syndicators' projections in the beginning, if they were getting tight and they were running kind of if they were conservative in their projections, running things as they should, then we should be okay. The reason I'm saying that is because your rental increases, well, they have increased. Rents have increased. Right now, rates are higher than, say, they were 3 years ago, but you always dial in higher exit test, right? And this is something I'm sure we talked about on the last call, is like for me, I always look at what my lenders are underwriting on their exits. and try to mirror that, because they're doing multiple of the deals I do, they do them. They're your largest investor. They're taking the biggest cash position in your deal, and they're going to pay attention to that. I also look at rate cap providers, because those guys they live and die by the cost, by where rates are going. They're gambling, So underwriting and projecting conservatively in the beginning is where you're going to do okay in a market like this. The folks that were kind of running fast and loose, playing with the magic exit cap rate to make a deal work, yeah, they could have some trouble. The positive is there's so much additional capital that wants to get into this game. If you look at historically through recession after recession, multifamily performs better than any other commercial real estate asset class, right? And it's going to perform just because of the basics of it, right? So I don't feel like there's going to be a bloodbath, or people talk about 08 and kind of equate the next couple of years to that, but I really don't see that happening. We've got much more. We do have more conservative lending than we had back then. And in a multifamily space, we're producing cash flow, right? Some fund is going to jump in there and snatch that property up. I get people ask me all the time about special servicing and where they can find the deals, and how do they get in to snatch these deals up that are going south. Mm-hmm. When there's that much dry powder and capital on the waiting blocks, or on the blocks ready to go, you're going to get priced up. Once again, you got everybody in the starting line waiting for that green light.
Right.
I think it's going to be fine. There's going to be some pain. There's going to be higher cap rates. We know that, but proper planning and conservative planning, like I'm sure you preach all the time, that's what's going to get you through it, because we're not working on 6-month cycles here, right? We're not flippers. We're working, 3, 5, 7, 10-year terms. So.
Yeah, let's talk about that proper planning, because the thing I definitely want to talk about are these rate caps, right? Because it sounds like with such an increase in the interest rate really rising quickly, it's not so much that it's risen from wherever it was to wherever it is now. It's just the speed at which it's risen, over the last 18 months or 24 months. We do have some sort of beginner syndicators, or some that may not even have done deals yet. So you want to explain a little bit about what exactly rate caps are, and have you seen some problems with those rate caps? As you said, some maybe not underwriting conservatively or quote unquote properly, accounting for that, and actually rolling the dice and not doing rate caps. So let everybody know what a rate cap is, and how it plays, and what you're seeing in the market with rate caps right now. Sure.
It's first of all, it's very valuable, right? It's looked at as a negative because it was so expensive, but imagine having an adjustable interest rate and having an insurance policy, for lack of a better term, an insurance policy on your rate, so that if it goes up by a certain amount, that rate cap provider starts to reimburse you for any amount over what they call your strike price. So it might be 150 basis points over your start rate. It might be 200 basis points over your start rate, or 1.5%, 2%, 2.5%, something like that. Or they can also do like 150 basis points in year one, and then 200 basis points in year two, so they can graduate it. But all that means is that if your interest rate increases over that amount, that rate cap provider will reimburse you for the difference. I can tell you from personal experience, I have hit some caps, and it has been very comforting to know that we've got the income to cover it. It's like any other insurance policy. It's always too expensive until you need it, and then you didn't have enough of it.
But talk about that, because that's one of the issues, right? I mean, at least let me see. When I was in Florida at the peak of the rates, I mean, the rates got crazy. I mean, 3-4 months ago, to buy rate caps, the price of those things were so high that I don't know if a lot of people decided to just bail on the cap rate on the rate cap, or they end up passing on the deal because of those premiums.
Well, what's interesting is it's usually a lender requirement. They're the ones that want to cover their assets, mm-hmm. and make sure that their borrowers have those rate caps in place. So it's a protectionary measure for the lender. Usually it's going to be required by that lender. Some lenders don't require them, and I scratch my head on why or how. And I know some of their borrowers that are kind of stretching to make their debt service and cover their debt service right now too. So yes, it's not really a borrower decision whether to pass on it, because most of the time it's a lender requirement. When we talk about institutional borrowers, sometimes they'll require it as well, because they have to provide protectionary measures to their investors. But for the individual investor like us, if the lender does a requirement, we can always buy one. But to your point, Mauricio, it was extremely expensive. Now, I haven't priced one out since since our rates dropped. My expectation is that they are going to be cheaper now because of what the expectation of rates are, right? They're not expected to continue to fly off the handle like they have. We're not in the same market as we were a year ago. So, and that's something else we were talking about today, is I expect rate caps to be a little less expensive now. Still expensive, but a little less expensive. So that's my expectation.
And that goes back to that word, right? Expectation. What does the market expect the rates to do over the next 6 to 12 months to 18 months? And if they expect rates not to go up much, then I presume the premiums, they're much willing to make that bet, because they're thinking the rates are going to start coming down.
Yeah, and when you look at the forward curve now, they are expected. Again, we're at the tail end. We're not done, but we're at the tail end of this tightening cycle. We should expect, and be prepared for, at least, or not surprised by, another slight increase in rates. Right? That we talk about SOFR rate. If you look at the curve on that, the projections have it kind of topping out right up just over 5, and we're at like 4.9 something right now. So moderate increase there, but nothing ridiculous as it stands right now. Nothing ridiculous where it would break a deal and blow it out of the water. And then from there, when we start looking at Q1 24 and so on, that the expectation is that rates would come back in line. And so nobody can make a prediction, but I try and look at what my lenders are doing. I try and look at what my rate cap providers are seeing and pricing off of, and that's what they're looking at.
Yeah, and Maximo had a great question, because again, I think there's a lot of people who are just starting out or haven't done one of these. So Maximo was asking, hadn't actually heard of rate caps, which I think a lot of people haven't. How does that get priced? So you have like an estimated cost. I mean, obviously it's going to change almost daily, if not weekly, but is that based on, obviously I presume it's the spread on what the current interest rate is and whatever kind of cap you're trying to buy, but how do you actually price that rate cap?
Rather than starting to talk about specific numbers and tell you, hey, a $3 million deal with a 1.5 spread is going to be X, because that's a moving target. Sure. I can't give you specifics, but I can give you the metrics of what they're going to look at. Number one is the strike, right? And the strike is how far that cap has to go up before that rate cap kicks in. The second thing is, and this is the number of years that you're taking it out. So most lenders, if you have a 3-year term, they will allow you to do and pay for a 2-year cap at closing, and they will escrow for an estimated cost for the 3rd year's cap. But they would want you to buy that 3rd year cap. They just may not collect it right up front. So that's what they're going to look at too, is the length of time that cap's in place, the spread. I've talked to some rate cap providers about how much the loan amount actually impacts the price, and they didn't compute with me. I'm thinking it has to have a huge impact on it, right? They said it doesn't have as much of an impact as your strike does. That strike is really what is, from what they've told me, that strike is really what drives it up. But those are the key components that you're going to look for, is the length of time it's in place and the amount of the amount it can go up before they have to start making payments.
Yeah, thanks for that clarification. And actually, that escrowing in year 3 or whatever year that is, in terms of they won't ask for that funds being escrowed. That's some of the issues we're seeing now. Some of the operators, the lenders are coming to them, they're asking for that money to be escrowed, and of course they don't have it. So in order to make that happen, they're having to resort to cash calls. And I think that's sort of the first round of cash calls that we've been seeing, is because lenders are asking for those escrowed amounts that, maybe they only asked for the first 2 or 3 years, and now it's a bridge loan or whatever. But now they're sort of either renegotiated or now coming to collect from the piper. What do you think are the biggest issues right now? I mean, we talked about the rate caps, bridge loan expirations. I mean, what do you, in terms of, especially over the last couple of weeks, we had that issue with the foreclosing, those properties that go foreclosed in the Houston market, which kind of made its way through all of social, made the front page of the Wall Street Journal and everything. And the question is that just the first of many, but what are the things are you seeing in the market that's causing issues to sort of operators that are currently have, that have bought 2 or 3 years ago or recently? Anything else that we've missed in terms of issues?
Yes. Well, I won't say that we've missed them, because there's,
of course,
we could do a 3-hour term here, but a huge component right now, and deals are falling out of bed for this reason, is insurance, especially in coastal areas. We're getting crushed on our insurance. I mean, if you can even find somebody to write in Florida, you're doing well, but they're hitting you at $2,500 a door, $2,000 to $3,000 a door.
This is hurricane insurance? Hurricane insurance? Or just?
Well, I mean, casualty insurance, property insurance. Yeah. I mean, and it's south of Houston. I just got a quote for $1,700 a door.
Wow.
And that was not bad, actually. That was, it was $1,400 to $1,700. So that's been crushing cash flow. For a long time, that the tax reassessment was really nailing us. And we still feel that tax reassessment, but we're kind of accustomed to it and we're dialing it in. But this recent insurance issue is something that's really kind of stepping up. Agency lenders require that you insure up to replacement value. And for a long time, your insurance companies are using $84 a square foot to $96 a square foot Marshall Swift rules. That's increased to $125 a square. And
why is that, Eric? Why is that? Why is it increased? Is it specifically the hurricane? Is it the hurricane component to that insurance, or is that happening in California, for example? We got fires and earthquakes over here.
Yeah, it's across the board. It's across the board on the adjustment to a higher replacement value. And I don't think we can just isolate it to hurricanes, because the Midwest sees a lot of tornadoes. They get hit with it as well. So each region has its own reasons and natural disasters that they battle, but it's a national issue. So obviously some regions are less expensive than others. And I, of course, for the sake of the conversation, I highlight the really expensive ones. Otherwise you guys would get bored, right?
Yeah, right, exactly.
But yeah, it's been an issue. So, and Fannie and Freddie, they require coverage up to at the replacement value, right? Whereas your banks and credit unions, they may only require coverage up to their loan amount. And we as borrowers say, well, why do you need coverage over your loan amount?
Right.
We're going to get your money back. But Fannie and Freddie, they have a mantra. They are mission driven, right? That is, they're not here to give us low interest rates on our loans and attractive loan terms so that we can make money as investors. They're here to ensure that the blue collar American has a clean, safe place to live. And if we say, look, we're just not going to rebuild it and you're going to get your money back, they just lost units. It was counterintuitive to their mission. And they want to see that we're going to rebuild this. Right. And that's been the explanation that I've received, because I've had that conversation with them numerous times.
Yeah.
So they want replacement value, and that's really jacking up the insurance rates.
Yeah, makes sense. Jared Lutz is one of our good regulars here that always has a blockchain question. And he's like, I can't think of a blockchain related question, but I'm gonna get in a blockchain related question, Jared. And it's just more of an open-ended. Are you seeing blockchain making its way, or do you foresee blockchain making its way into the lending industry? Are you starting to see inklings of it, or is it basically hasn't shown up in your universe yet?
It has not shown up in my universe yet. I have asked about it, and whether to a number of industry professionals, title companies, and so forth, and everybody's looking around. They know it's there. They kind of know it's outside, but nobody can give me any solid information on it.
Yep.
So I'm open to it. I love it. I want to see the advancement of all this, but I have not seen it manifest itself. Hasn't knocked on my door yet.
Dan has a question about those Houston deals. Do you know much? Do you have any sort of thoughts on those Houston, the Appleway deals? Are you aware of those 4 properties that went BK? Do you have any? I mean, look, before you even say anything, I mean, there's so much stuff swirling around on social media, and I don't know if anybody knows anything or has any real details. So, I hate to speculate or anything, but if you've got any general thoughts on what went wrong or how it can be avoided, any general thoughts on those Houston properties?
Well, the first thing is I have more questions than I do answers. I haven't been able to get any insight into details that aren't available to everybody else.
Right.
One of the questions that I have goes back to what we were just talking about, right? The common reason that everybody's reading about is that their rate went from 3.4 to 8. But I know that Arbor doesn't do anything without a rate cap. So maybe it was in there. I don't remember when those loans were originated, but maybe the rate cap expired and they didn't re-up it. I don't know what that number was, but I don't know Arbor to do anything without requiring a rate cap. I've got a couple loans with them now, and they require rate caps. So that would have kicked in. That would have offset that debt service requirement. And if that was the actual reason, they would have been fine. Again, maybe there was some exceptions given just because of the solid funding of these investments. They're going to make exceptions for solid borrowers, and they want to build relationships. So that's a distinct possibility as well. That maybe the projections weren't where they needed to be. Another question I have is recapitalization. How could that shop, how could Appleway not be able to raise another round of capital and maintain these assets? Right. That's the other question I have. And Mauricio, you probably deal with these recaps quite often and people raising additional rounds of capital and stuff. To me, that would seem like the reason, unless they didn't want to, unless this is just so institutionalized that this is what they do.
Look, I don't know. These are not facts. That's why I'm sometimes hesitant to even mention. I had read on social media, which of course means it's true, that they had done a round of cash calls already. So they'd already tried to do some stuff. And sort of this would have been the second, which is tough. But I also did see, and it was corroborated by third-party media that those properties had a lot of issues, right? So, I mean, the occupancies were pretty low. They had a lot of crime in that area. They seemed to be a little bit absent. And so I think a combination of, when your cash flow, your NOI starts going down because of the occupancy factor. And I'm sure even if you had a rate cap, the interest rate is going to go up to a certain level until that strike point, right? So even if they're getting paid at that strike point, if their interest rate went up 2 points until they hit strike point, you got a higher interest rate, you got lower cash flow coming in, can't make your payments. And if you can't make your payments, like I said, maybe a cash call would have been an option, but then you're asking people to put money into a deal that may not be warranted. But again, there's just so much speculation. I think it's as an attorney, I always think it's dangerous to start saying stuff out there without really knowing what the facts are, because I just don't know what the facts are. Jared asked if there's any advantages for them to let the property fail.
And it's a great question, right? Because if it's a non-recourse debt, sometimes it's just a business decision to shift this portfolio and hand it off, right? The advantages, if you are bleeding cash and you're supporting this asset, we don't know how long they were funding money into this asset to keep it afloat. And at some point, they just have to stop the bleeding, cut their losses, and move on. So that would be, the immediate advantage to that is just to put a tourniquet on that thing and lose it.
Yeah.
And then you've got the advantage is to fundamental partners, right? The people who bought it for pennies on the dollar.
Yeah, and to Dan's point, he was asking about what the legal exposure is. I mean, unfortunately, I think all of these were syndicated, right? So you had limited partners, so you had passive investors who had invested. I think the number I heard was about $75 million. So they obviously lost their capital. And so the question is, what's the legal exposure? It's going to be the same as it ever is. It's not going to be a securities issue because the securities issue happens at the time of sale. So unless they can show that there was some kind of a misstatement, or they didn't disclose something they should have, most likely they're going to have to show that, hey, these guys were negligent. You're going to have to show that, hey, a reasonable, prudent manager wouldn't have allowed this to happen. That's going to have to be the legal burden for passive investors or anybody to bring a claim. They would have to show that a reasonable, prudent operator under the circumstances would have done something different, and therefore they fell below that standard. But whether they can prove that or not, I don't know, because I don't know the facts are. But there's potential legal exposure. Whether they'll go forward or not will remain to be seen.
I have a question for you there, Mauricio, and it's there's nobody better to answer it. I mean, rather than let that asset go, to the gentleman's point earlier, if someone was to come in with another round of financing, right, where they're going to dilute the shares, but they're not going to lose the shares, but they might dilute the shares or just have some other alternative structure to bring in some fresh powder to get those repairs done, to turn those properties around, and at least those investors wouldn't lose their shirts, wouldn't lose everything. Is that feasible? Is that
100%? So that's definitely an option. So I mean, if you need more cash for whatever reason, because you're short, you can't make the mortgage payments, or maybe your coverage ratio went below the required 1.2 or whatever it is these days, then yes, if you can convince people to come in. A lot of times though, people come in and they look at the deal and say, hey, look, this thing's underwater already. The property's worth less than the loan. Why would I put money into it? So it's just a question of whether the market has the appetite for that type of risk. But can you do it? Absolutely. Because again, at this point, it's an operational issue. It's not a securities issue, right? So there's provisions in the operating agreement, presumably, that provide for capital calls as maybe step one. But if for whatever reason they can't get the capital call, then the manager has that option to go to the market, whether it's getting a loan from. They obviously have the option to lend money themselves to the project, the sponsors do. And if they can't lend, or they've already tried to lend, we had a cash call episode a couple of weeks ago, and that was my first recommendation for the sponsors to first try and plug whatever gaps you have. Then you're going to go to your existing investors. And if they can't or don't want to, then you can go to the marketplace, whether that's a loan that you can secure, or maybe it's fresh equity. And maybe you have to, not maybe, you most likely will have to bring in a preferred equity group where they're going to get some priority above the LPs. But, if your alternative is your LP is going to lose 100% of their money, then diluting them by 50, 60, 70%, that's still better than losing all of your money. So those are definitely options out there. But and then the other option, by the way, this might be a great segue, because this is something that Ken McElroy has been talking about recently, because I guess he did this in a couple of his properties. But the other option, which I guess would have been in conjunction with raising some additional capital, is a term that I hadn't heard until I heard it from Kenny: a bail-in. Have you heard about the bail? Has anybody in your world done bail-ins? Everybody knows what a cash out refinance, kind of you're taking money out of the property. But what Kenny's been doing on a couple of his properties is he's got the same issue, right? But he's looking at variable rates, and he's not sure he doesn't know what interest rates are going to be like in a year or two, but he's got that exposure. And if it continues to rise, he's going to be in trouble. And so what he ended up doing was going to the bank and actually putting more additional capital to the bank, basically refinancing, but putting money in as opposed to taking cash out and locking in the interest rate today. So he's been able to go in there, right? Not an insignificant cash, right? But locking in an interest rate at whatever it was, to 5.5 or whatever today. But he's now locked that in for the next 5 years or 7 years or whatever that is, versus, man, my loan's going to expire here in the next year or 2 years, and I don't know what the rate's going to be. Have you seen much bail-in, or is that the right term that he's using, or is there another term for that kind of concept of doing sort of a cash in refi? Maybe that's what it really is.
Well, the the thing that I'm trying to conceptualize is what's that capital costing him? Where is that capital coming from? And is the value is just to lock in his interest rate for his existing debt?
I think it's a refinance of the debt to a sort of it's a refinance of the existing debt is my understanding. So he's refinancing, but he's locking in a 5.5% rate today versus what I assume he's got a floating rate going on. And so, yes, he's got rate caps going on, but the rates are going to continue to go up. So that's just a new concept. I don't know if that was just, if you've seen any.
Well, I'd like to say, I mean, I haven't seen it given a term like that, because that's always the goal, right? Is to refinance and lock in. I mean, I feel like somebody that wants to lock in a rate right now is counterintuitive to where rates are going, right? Rates are expected to drop. I have people that want shorter term notes right now so that they're able to refi in 2 years or 3 years into a lower rate long term. So I need to unpack that a little bit, and I'm going to look into what he's doing.
Look into that because he looks at it as a hedge, because maybe he has a different viewpoint than you in terms of like he may not think that rates are going to come down, right? If he thinks rates are going to continue to go up and there's a risk if that continues to happen, then for him that's a hedge, right? He's hedging against that possibility that the Fed's going to continue to raise rates and the 10 years is going to go up and the mortgages are going to go to 6, 7, 8. I posted, I think, for this particular thing, some different opinions of where the mortgages were going to be in 2023. Some people have it up there at 9. So if interest rates go to 9, you might be SOL. So I think it's just a way for him to sleep better. I know one of his properties, the NOI, I know this is just stuff that I've heard him talking on the podcast, so it's not like I'm talking out of school, but his NOIs on some of the properties have gone down. And so they just, that was the move. I think that it paid like just under $1 million, but they were able to lock in, the lower rate, refinance it and get their cash flow position a little bit better. But who knows? I just didn't know if that was a new term.
I have to say that I can't fault anybody for providing stability to their investors. To me, that I won't say it's priceless because there's always a cost to it, but that is extremely valuable. So I commend him for doing that and protecting his investors and refinancing so that he provides that stability. I think that's very commendable, and that makes sense to me.
Yeah. Maximo asks, whose shares get diluted? Is it usually just the GPs? No. It's the LPs who get diluted if that's the scenario. So everybody gets diluted. It's not just the GPs or LPs, but it's definitely the LPs. And if you look carefully in your operating agreement under the section of cash calls or additional capital contributions, you will typically see language. You'll definitely see language on our PPMs that state that if the manager deems it prudent in the best interest of the deal to raise additional capital and you don't comply with a cash call, then you will most likely get diluted if they're able to get money from outside sources, or maybe other LPs contribute more and you decide not to, you're going to get diluted, and that's usually drafted in the operating agreement. Robbie asks, where do these preferred equity groups come from? Or wait, where do you find preferred equity groups who prefer to come in as mezz financing? I'll give you my 2 cents real quick. So these preferred equity groups are really good if you talk to them before your deal, which, by the way, this particular deal in Houston, I understand they had private equity or preferred equity in their deal as well. So that's where you can negotiate with them. You say, hey, look, I've got my investors are raising 65% of the money, and they bring in another group, a preferred group that maybe puts another 10% or 15%, and that's fine. My experience, I've gone through this a few times with clients, is that if you are desperate for cash, the deal's not going well and you need a preferred equity player, they're going to come in and they're just going to, what's the kid-friendly term? They're going to stick it to you. They're not going to come in and the terms are going to be onerous. They're not going to be pretty. They're going to be first in, first out, and they're not looking for your best interest. They're just ugly terms. They're giving an arm and a leg, to put it nicely, if you bring in a preferred equity group when the deal's in trouble. So that's about the worst type of capital you can bring in my experience. But Eric, what say you?
I feel like it's capital providers in general are consistent with the risk of the deal and consistent with the stress points of the deal, whether you're talking about a hard money lender or you're talking about an opportunistic, I think, what was it Jared mentioned earlier, a vulture fund or something like that,
Yep.
you know, what's it worth to you?
Right.
And that's really what it comes down to. I can tell you that a lot of these PE shops, you've got to be careful with them, because they are, you know, they're going to invest a lot of time underwriting your deal. There are shops out there that want upfront monies just to look at your deal. And I've got clients that have been giving them $25,000, $35,000 so that they can be told no, they don't want to invest in their deal. Or they go with them and they have what's called a hard preferred or a hard pref. And there's a difference between a soft pref and a hard pref. Everybody knows what a preferred return is, right? Let's say you're going to pay the first 6% that comes in the door. What happens if you don't pay that? A soft pref is where your investors don't have the ability to take over control of that general partnership and run the deal. That's what Fannie Mae and Freddie Mac require, is a soft pref. If you have a hard pref, that means that that company that put that money in can take over control if they don't get paid, and your lender will need to underwrite that firm because they consider them a proposed borrower, a potential KP. Because if you don't pay your pref and they take over, now all of a sudden the people that signed on their carve-out, signed the loan, are no longer in control of the asset. So there's a lot to consider when you're talking to these PE shops. A lot of times they're not as concerned with cash flow as they are with the back end equity, or the inverse. A lot of times they're not as concerned with what they're getting in the back end. They just want to see that they're getting X percentage in cash flow. So it can be beneficial there, but there's a lot of extras that you're really going to have your attorney roll up their sleeves and work with them, because I guarantee you they spend a lot of money on their attorneys. So you're going to have to spend a lot of money on yours.
Yeah. And you got to remember too, and this is another point I heard Kenny talk about, I think yesterday on somewhere, that, you know, with cap rates have gone up, you know, and some of these places, the property values are off 20% from sometimes 25% from when they bought them. And so some of these deals are already underwater. Like they literally have been coming to Kenny, and Kenny's looking at them. It's like, I think this thing is worth less than the loan. And so it's kind of a pass at this point for some of these preferred equity groups. Now, if they were able to buy it at a discount or something, but that's the challenge is if you bought the stuff a year and a half ago, and your properties, the cap rate's gone up a point, you know, there's not much equity in there based on the cash flow that's coming out. But anyway,
very true. And that's what everybody's talking about is when those properties go to refi. But I still believe that's a function of not executing your basic plan, right?
100%.
Not executing your rent lift. You're trying to capture these rents. Maybe you didn't comp it out right. You know, conservative underwriting in the beginning is what's going to save you, in my opinion.
Yeah, no, 100%. Eric, where can somebody find you? I know you've been super generous with your time today, and if somebody wants to get a hold of you to talk about lending, and because I know that's something you offer, what's the best place for people to reach you?
Well, it's archaic. I know I'm a bit of a knuckle dragger when it comes to social media, but you can call me on my cell phone and you can email me. People still send regular emails now.
Love it. I'll put that in the chat, and I'll put it in the show notes too.
Sure. My phone number is 321-615-8919. Office number 800-916-9005. And my email is erics@atlantic.com.
Got it. I think I got it all in there in the chat. But Eric, my friend, always appreciate you, especially this one was like always last minute. Hey, what are you doing tomorrow? Can you spare an hour? So I really, really appreciate you taking time out of your busy schedule. We all thank you. And we'll look forward to maybe reconvening in another 6 months to see where we're at.
That sounds great. I really appreciate you having me. It's always a blast to get on and chat with you. And I think I'm going to see you later this month. So
I understand too. We'll be in Arizona together. Sounds good.
Absolutely.
All right, buddy. Good seeing you.
Thanks, guys.
Thank you.
Thank you. Take care.